Welcome back to the Community Corner podcast, where we explore the companies in the S500 through the lens of behavioral finance. I'm Arnav.
And I'm Nikhil. Today, we're focusing on Union Pacific Corporation, one of the largest railroad networks in the United States, providing freight transportation services across the country. We'll be discussing how behavioral finance impacts their decision-making, diversity and inclusion efforts, adaptation to different markets, and how they compare to other companies in the industry. Let's get started.
Union Pacific has a long history as a cornerstone of American industry, but from a behavioral finance perspective, how do biases like status quo bias and loss aversion influence their decision-making, especially in areas like infrastructure investment and operational strategy?
Status quo bias is particularly relevant to Union Pacific's approach to its core operations freight transportation across its extensive railroad network. The company has a well-established infrastructure that has served it well for decades, leading to a preference for maintaining and optimizing existing assets rather than making radical changes. This bias towards the status quo helps Union Pacific continue to operate efficiently and reliably, but it can also slow down the company's adaptation to new technologies or changes in the logistics landscape, such as the shift towards more environmentally sustainable practices. Loss aversion also plays a critical role in Union Pacific's strategy, particularly in how the company manages its capital and invests in infrastructure. Given the capital-intensive nature of the railroad industry, Union Pacific is focused on ensuring that its investments yield strong returns and that operational risks are minimized. This focus on avoiding financial losses drives the company to prioritize investments that enhance the efficiency and reliability of its existing network, while cautiously exploring new opportunities that align with its long-term goals.
And this focus on maintaining core strengths and disciplined capital allocation has helped Union Pacific remain a reliable and profitable player in the transportation industry, appealing to both customers and investors who value stability and consistent performance.
Exactly. Union Pacific's strategic use of status quo bias in optimizing its existing operations and loss aversion in capital allocation appeals to investors looking for a company that prioritizes financial stability and long-term growth. However, this approach also means that Union Pacific must carefully balance the need to innovate with the importance of maintaining its established market leadership, particularly as the transportation industry continues to evolve with advancements in technology and sustainability.
Let's talk about diversity, equity, and inclusion at Union Pacific. As a major transportation company, DEI is particularly important for Union Pacific. How does this intersect with behavioral finance?
Union Pacific's approach to DEI is essential, especially as the company operates in a diverse range of markets and communities across the United States. From a behavioral finance perspective, strong DEI initiatives can enhance Union Pacific's ability to attract and retain a diverse workforce, which is crucial for fostering innovation and maintaining its competitive edge in the transportation industry. A commitment to DEI allows Union Pacific to better serve its customers by reflecting the diversity of the communities it operates in, which can improve customer relationships and operational efficiency. For investors, Union Pacific's focus on DEI can signal that the company is socially responsible and aligned with modern societal values, which can enhance its reputation and appeal to ESG-focused investors. Additionally, DEI efforts can help Union Pacific build stronger relationships with employees, partners, and local communities, which is vital for long-term success in the transportation industry.
Investors are increasingly considering DEI when evaluating companies, especially in industries like transportation, where the ability to serve diverse markets and foster innovation is critical to long-term success.
That's right. By embedding DEI into their corporate culture and operational strategies, Union Pacific not only improves its ability to serve a broad range of customers but also strengthens its market position and attractiveness to socially conscious investors.
Moving on to global markets, Union Pacific primarily operates within the United States, but it plays a critical role in the global supply chain through its connections with ports and international trade routes. How does the company adapt to different market demands, and what role does behavioral finance play in this?
Union Pacific's strategy involves leveraging its extensive railroad network to meet the specific needs of different industries and regions within the United States, while also facilitating international trade through key port connections. From a behavioral finance perspective, this adaptability is crucial for managing the risks associated with fluctuations in global trade and domestic market demands. Union Pacific's ability to navigate complex logistics, such as varying demand for freight services and changes in trade policies, allows it to maintain a strong presence in the U.S. transportation sector. The company's approach to understanding market dynamics and adapting its strategies accordingly helps mitigate risks associated with economic cycles, regulatory changes, and shifts in consumer behavior. By ensuring that its transportation services are efficient and reliable, Union Pacific can continue to expand its market share and strengthen its role in the global supply chain.
And this adaptability is essential for Union Pacific, especially as they face competition from other transportation modes such as trucking and shipping. Their ability to maintain their brand's relevance and leadership in the freight industry is key to their continued success.
Exactly. Union Pacific's focus on understanding market dynamics and adapting its strategies accordingly allows them to remain a dominant player in the transportation industry while staying ahead of emerging trends and challenges. However, this also requires them to be proactive in responding to changes in global trade patterns, technological advancements, and competitive pressures.
Now, let's compare Union Pacific to other companies in the transportation and logistics industry, like CSX Corporation, Norfolk Southern, and UPS. How do the behavioral finance dynamics differ?
Union Pacific's dynamics are often compared to other transportation and logistics giants like CSX Corporation, Norfolk Southern, and UPS, particularly in their approach to infrastructure investment, operational efficiency, and market expansion. Union Pacific's strength lies in its extensive railroad network and its leadership in freight transportation, which appeals to investors looking for a company with a stable foundation and critical infrastructure. CSX Corporation and Norfolk Southern, both major U.S. railroads, appeal to investors interested in companies that focus on efficient freight transportation and have strong regional presences in the eastern U.S. UPS, known for its global package delivery services, attracts those looking for exposure to the broader logistics and e-commerce sectors. Union Pacific's behavioral finance dynamics are shaped by its reputation for reliability, strong operational efficiency, and adaptability, making it an attractive option for those seeking stability and growth in the transportation industry.
And unlike UPS, which is heavily focused on global package delivery and e-commerce, Union Pacific's strength lies in its leadership in freight transportation across the U.S., appealing to a different type of investor and market.
Absolutely. Each of these companies has its own behavioral finance dynamics that influence how investors perceive their value and potential risks. For Union Pacific, the focus on freight transportation leadership, strong infrastructure, and market adaptability provides a unique value proposition in the transportation industry.
To sum up, Union Pacific's approach to business is deeply influenced by behavioral finance principles, whether it's through their infrastructure investment strategies, market adaptations, or their approach to DEI. But like all companies, they are still subject to the biases and perceptions that can influence investor behavior.
That's right. Understanding these dynamics provides a clearer picture of what drives Union Pacific's stock price and where the potential risks and rewards lie.
Thanks for joining us on this episode of the Community Corner podcast. Until next time, I'm Arnav.
And I'm Nikhil. Stay curious and keep questioning the narratives.